Global debt stands at $318 trillion. The world's annual economic output? Just $105 trillion. That's a leverage ratio of over 3 to 1, a structural fracture that no healthy system sustains. Silver trades at $64 per ounce, as if this imbalance doesn't exist. Yet physical deliveries are stalling. Dealers report premiums spiking 20 to 30% above spot, with delays hitting weeks. Banks quietly adjusted futures margins overnight last quarter, tightening leverage on shorts, but the squeeze only accelerated. Institutional flows into physical bars surged 45% year over year, while paper contracts dumped. This isn't volatility. This is the kill switch failing mid-activation. The system is hemorrhaging control right now, and the silence from regulators screams louder than any headline. I see it unfolding in real time, piecing together the signals from market feeds, central bank reports, and historical echoes. The debt pile isn't just a number. It's a pressure cooker compressing every asset class. Silver, that dual-role metal wired into industry and monetary history, should be exploding upward. Instead, it's pinned down by mechanisms that worked for decades but are now cracking under the weight. Look at the futures market. COMEX positions show net shorts by major banks at record highs, over 100,000 contracts, equivalent to 500 million ounces. That's artificial suppression, a kill switch designed to cap prices and maintain fiat illusion. But here's the break. Open interest dropped 15% in the last month alone, as hedgers unwind, signaling capitulation. Physical demand from solar, electronics, and defense sectors hit 1.2 billion ounces annually, outstripping mine supply by 200 million. The gap isn't closing, it's widening, forcing refiners to ration. This mismatch didn't start yesterday. It's the late-stage symptom of a 4-act cycle that's played out across empires, republics, and superpowers. We enter with hard money, gold and silver as anchors, building trust through scarcity. Growth follows, but so does greed. States inflate, debasing coins, printing notes beyond reserves, to fund wars, welfare, or whims. Inflation creeps, then surges. People flee to tangibles. The currency collapses, resetting everything. Survivors hold real assets. Losers cling to paper. We're deep into Act 3 now, where the debasement accelerates, but the facade holds. Just barely. Take Rome as the mirror. Nero, post-64 AD fire, faced empty treasuries from disasters and conquests. Silver content in the denarius dropped from 95% to lower grades overnight. More coins, same metal supply. By Septimius Severus in the 190s, it's 46%. Caracalla introduces a double denarius with scant extra silver. Under Gallienus in the 260s, down to 5%. Wheat prices triple. Soldiers demand goods, not coins. Bad money drives out good. Gresham's law in action, economy fragments. Constantine resets with new gold solidus in 310 AD. Old denarii worthless. Millions for one solidus. Rome, the eternal city, couldn't outrun the math. Their debt-to-output ratio? Estimates put imperial obligations at levels mirroring our 3 to 1 today, funded by debasement until the system snapped. Fast forward, and the pattern repeats with mechanical precision. Weimar Germany, 1914 to 1923. Gold standard abandoned for a short war. Loss brings Versailles reparations, 132 billion gold marks, equivalent to over $500 billion now. Annual payments devour 25% of GDP. Taxes cover only 37% of spending. Reichsbank prints. Mark starts stable. By early 1922, 160 to the dollar. December, 7,400. Hyperinflation hits 1923. French occupation of Rouen. Government pays strikers nothing wages. June, 100,000 marks per dollar. October, 170 billion. November, 4 trillion. Workers paid twice daily. Money worthless by afternoon. Farmers hoard food, refuse paper. Middle class obliterated. Rent mark introduced November 15th, 1923. 1 trillion old marks for one new. Reset. The shock paves Hitler's path. Again, debt overwhelmed output. Debasement followed. Tangibles saved those who saw it. Now, overlay the US arc since 1971. Nixon closes the gold window August 15th. Dollars no longer redeemable for gold at $35 per ounce. Temporary, he claims, to stabilize. It's permanent. Pre-1971, dollar gold backed, basis for Bretton Woods boom. But Vietnam, Great Society programs inflate supply, 4 times more dollars than gold reserves. Post-Nixon, no limits. 1970s stagflation, oil shocks. Gold rockets from $35 to $850 in a decade, 24-fold. Not gold rising, dollar falling. Printing never stops. 2008 crisis, trillions created. 2020 COVID, 6 trillion in 18 months. US debt now 36 trillion. Annual interest 892 billion, exceeding defense spending. Projections, 1.7 trillion by 2034. Productivity rises, but real wages flatline since 71. Average earner saved for a house in 2.5 years then, over 7 now. Wealth gap widens as assets inflate, purchasing power erodes. Silver fits here as the canary. Historical gold-silver ratio, 15:1 to 50:1 averages. Crises compress it. Current, 67:1, with gold at $2,300. Wait, no. Signals show it pushing 4,300 in futures bets, but spot holds lower amid volatility. Typo in feeds? Irrelevant. The ratio screams undervaluation. If it normalizes to 50:1, silver hits $80, up 25%. Inflation adjusted 1980 high, $194 today. 2011 peak, $70 adjusted. Yet at 64, it's trading as if debts are manageable, printing sustainable. That's the illusion cracking. Banks' kill switch? Overnight rule tweaks on margins, position limits. Last seen in Q3 2024 filings. Intended to flush shorts, but backfired. Physical withdrawals from vaults spiked. LBMA reports 15% depletion in allocated silver. Major players, JP Morgan, HSBC, hold massive derivatives, but filings show them shifting to physical offshore. Why? Because paper's decoupling from reality. Supply chains fracture. Mines output flat at 800 million ounces yearly, but industrial pull, solar up 20%, EVs 15%, drains inventories. Geopolitics amplifies. Russia, China stockpiling. BRICS reserves up 30% in gold or silver equivalents. Sanctions disrupt flows. Peru, top producer, hit by strikes. Output down 10%. This isn't isolated. It's systemic loss of grip. Regulators' silence? A signal itself. SEC, CFTC filings bury the shifts in footnotes. Media gloss is over. No headlines on the 45% institutional pivot to physical. Why the quiet? Because acknowledging the fracture invites the run. In Rome, emperors downplayed debasement. Weimar officials promised stability mid-printing frenzy. Nixon called it temporary. Patterns don't lie. Here's where the logic bends. If debts were sustainable, silver premiums wouldn't detach from spot. Dealers wouldn't cap orders at 100 ounces per client. Yet they do. If the system held, why do central banks hoard gold at record paces? China up 200 tons last year, Russia 150. Silver follows, quieter but critical for tech defense nexus. Military demand alone. Hypersonics, radar, up 25% amid tensions. This ties markets to geopolitics. Dollar weaponization in sanctions pushes alternatives. BRICS talks de-dollarization, backing with commodities. Silver's in that basket. If you're tracking commodities or finance from the inside, perhaps in trading or mining, how does this premium disconnect look on your end? Write it in the comments. Your observations could sharpen the picture for all of us. Peel back further. The kill switch failure exposes the fiat machinery. Post-1971, dollars multiply unchecked. Global debt triples GDP because borrowing props growth, but it's phantom. Real economy, manufacturing, resources, stagnates relative. Silver's industrial side amplifies. 50% demand from tech, yet prices lag. Anomaly? No. Suppression to mask inflation. But physics intervenes. Shortages manifest. Refineries in Europe report backlogs. Asian fabs scramble for stock. This echoes Weimar's food hoarding. Producers hold back against depreciating currency. Compare to Rome's soldier pay. Doubled nominal, halved real via debasement. Today, wages up nominally, down against assets. House prices, up 300% since 71, adjusted. Food, energy, health, double-digit creeps yearly. System loses stability where trust erodes. People shift savings to tangibles. ETF outflows from paper silver, 20% drop. Physical mint sales. US mint up 35%. Perth mint rationing. This interweaves with logistics. Shipping disruptions. Red Sea, Panama. Delay ore, refined bars. Costs up 15%. Geopolitical layer. Ukraine, Middle East drain munitions. Spiking silver use in electronics. Yet banks tweak rules nocturnally, hiking margins on silver futures to 12% from 8% per CME notices. Aim, deter spec longs. Result: accelerated unwind as big players exit paper for vaults. In Weimar, the Ruhr occupation triggered the print spiral. Here, proxy wars and trade frictions do the same. Debt service crowds out investment. U.S. interest bites deeper than military budget. Can't raise rates without implosion. Can't cut without hyperinflation. Stuck. If you've seen similar rule changes in other assets or regions, how do they align with this silver squeeze? Share your take in the comments. It's these cross-checks that reveal the full fracture lines, deeper into the cycle. Act 3's hallmark is the panic pivot. In Rome, citizens hoarded old coins. Weimar, barter emerges. Post-Nixon, gold, silver runs. Now, institutional hoarding. Pension funds allocate 5 to 10% to metals, up from 2%. Why? Because 318 trillion debt demands resolution. Default, inflate, or reset. History favors inflation, revaluing hard assets. Silver's undervaluation. Gold-silver ratio at 67 to 1 ignores crises compressing to 20 to 1 or lower. In 1980 Hunt, it hit 17 to 1. Today, with debts 3 times GDP, ratio should contract. At 30 to 1, silver $140. But Banks's kill switch, derivatives overlay, held it. Until now. Vault audits show drawdowns, premiums confirm scarcity. This isn't growth, it's rupture. Mines can't ramp. Environmental regs, labor costs cap output. Demand inexorable. Green transition needs 300 million more ounces by 2030 for solar alone. Defense. Classified, but leaks suggest stockpiles low. Historical mirror flips cause effect. Debts drive debasement, but debasement fuels more debt. Rome's wars necessitated coin clipping. Clipping weakened empire, inviting more wars. Loop closes. Today. Printing funds deficits. Deficits erode trust, necessitating more printing. Silence from media. Calculated. Focus on equities highs. Ignore commodity strains. But signals leak. Dealer blackouts on large orders. eBay premiums 40% over spot. If you're in supply chains or retail metals, what's the ground level view on these delays and rations? Drop it in the comments. Collective intel maps the instability better. Push the analysis. The system's losing equilibrium at the monetary metal nexus. Fiat's promise, stability via policy, fails when math intervenes. 105 trillion output can't service 318 trillion without erosion. Zin's payments escalate, forcing choices. Austerity, politically toxic, default, systemic, or inflate, stealth tax. Silver exposes this. As money metal, it's insurance. As industrial, it's necessity. Dual pressure. Banks' overnight rules. Position caps tightened, meant to stabilize, but sparked exodus. Paper trades detach. Physical commands premium. Geopolitical weave. De-dollarization accelerates. BRICS currencies. Commodity-backed hints. Russia-China trade in yuan, ruble, settling in gold, silver. U.S. sanctions boomerang, pushing reserves diversification. Central banks bought 1,000 tons gold last year. Silver quieter, but Indian imports up 50%. This mirrors Constantine's reset. New currency after debasement peak. We're approaching that pivot, but non-linear. Symptoms precede full cause revelation. In every cycle, the middle class bears the brunt. Weimar wiped savings. Rome fragmented classes. Today, inflation taxes the static, rewards asset holders. Real wages stagnant 50 years, while productivity up 200%. Disconnect. If this wage-asset gap resonates with your experience in labor or investing, how do you interpret its link to the broader debt cycle? Write your perspective in the comments. It adds layers to the analysis. Unpack the kill switch mechanics. Banks, as market makers, use futures to hedge, but also suppress via naked shorts. Regulatory winks allow it, until physical drains expose. Recent changes. Nighttime filings hike collateral, flushing small players, but whales pivot to OTC physical. Result? COMEX deliveries up 25%, but fulfillments lag. This ties to history's Act 4, collapse and rebirth. Rome's solidus, Weimar's Rentenmark, potential post-dollar reset. Not if, when. Patterns enforce it. Industry angle. Silver's 1.2 billion ounce demand versus 1 billion supply. Deficit covered by recycling, but that's finite. Solar, 140 million ounces. EVs, 80 million. Defense, 50 million. Growth trajectories, 10 to 15% yearly. Mines, Peru down, Mexico stable, Australia flat. Geopolitics, tensions hoard strategic metals. US stockpiles, classified low per leaks. China dominates refining, 80% global. Banks botched the switch. Tightening sparked the run they feared. Now, premiums signal scarcity, dealers limit sales. If you've noticed parallel suppressions in other commodities amid this debt backdrop, what's your read on why they're failing now? Share in the comments. Diverse views test the pattern's universality. Final layer. The process is mid-motion. Debt leverage at 3 to 1 demands rebalancing. History shows through asset revaluation. Gold, silver surge as fiat fades. At $64, silver's not priced for this. It's discounted denial. Regulators inaction, complicity or paralysis. Media blackout, distraction. But markets whisper truth. Ratio compression incoming, premiums persisting. This isn't end times hype, it's observation. The machine grinds on, indifferent to exceptions. Rome thought eternal, Weimar innovative, US exceptional. Math disagrees. If the historical parallels to today's signals strike you differently, perhaps stronger in one era over another, explain your interpretation in the comments. It refines the collective scan of where we stand. We sit in the fracture zone, where control slips, one anomaly at a time. The kill switch on silver misfired, exposing the wiring. The cycle advances, unyielding. Global debt has breached $346 trillion as of Q3 2025, against a world GDP hovering around $117 trillion. That's a leverage ratio approaching 3 to 1, sustained only by mechanisms that no longer hold. Silver trades near $67 per ounce, yet physical premiums detach sharply. Dealers quote 30 to 50% above spot for immediate delivery, with wait stretching 4 to 8 weeks on standard orders. COMEX raised margins mid-year, triggering a brief retreat, but the rally resumed harder, up over 120% year-to-date. Institutional withdrawals from vaults accelerated, inventories down 20% in key hubs. This isn't correction. This is the suppression tool backfiring in real time, as physical scarcity overrides paper controls. The fracture widened this year, signals converging from every angle. Debt accumulation added $26 trillion in the first 9 months alone, $675 billion weekly, while output growth stalled at low single digits. Silver's dual nature exposes the strain. Half its demand industrial, locked into solar panels, EV wiring, defense electronics. Annual offtake hit record highs. Solar alone consuming over 260 million ounces projected. EVs another 90 million. Data centers and AI infrastructure pulling unexpected volumes. Mine supply flatlined near 820 million ounces. Recycling can't bridge the 200 million ounce gap. Refineries ration input. Lease rates spiked to 40% briefly. Borrowers paying premiums just for temporary access. That's not speculation. That's manufacturers scrambling to keep lines running. History mirrors this phase precisely, where containment fails and revaluation begins. Rome's emperors clipped coins until soldiers rejected payment, demanding goods instead. Weimar's presses ran until wheelbarrows of marks bought bread, if farmers accepted paper at all. Post-1971. America printed without gold restraint, watching tangibles detach as purchasing power eroded. Each time, the pivot came when physical claims overwhelmed the illusion. Today, central banks bought over 600 tons of gold through Q3, diversifying reserves amid dollar weaponization fallout. Silver follows quieter, but Indian imports surged. Russian and Chinese stockpiles grew. Strategic metals for tech and defense, not just monetary hedges. US debt alone hit $38.4 trillion by December. Interest payments crossing $1 trillion annually for the first time. More than defense, crowding everything else. Rates can't rise without implosion. Cuts fuel inflation. Stuck equilibrium, eroding trust incrementally. Real wages stagnate against asset inflation. Middle layers feel the squeeze first. Silver's ratio to gold compressed to 65 to 1 from over 100 earlier this year, yet still elevated historically. Crises pull it tighter, silver catching up violently. Banks' margin hikes. COMEX front-month requirements up 11%, Shanghai to 19%, aimed to cool speculation, but physical flows only intensified. Deliveries lagged, premiums widened, dealers capped orders. London vaults drained, transatlantic shipments booked urgently. This echoes the failed interventions of past cycles. Tighten paper, accelerate flight to real. If you're in manufacturing or supply chains, solar fabs, EV assembly, electronics, how are these shortages and premiums impacting operations on your end? Share specifics in the comments. Ground-level data sharpens the broader view. Deeper signals tie markets to geopolitics. Tariffs disrupted flows. Sanctions pushed alternatives. BRICS discussions commodity-backed settlements. Russia-China trade bypasses dollars, settling in metals. Defense demand classified but rising. Hypersonics, radar, munitions electronics up sharply amid tensions. Silver's strategic tag by U.S. authorities this year confirms it. Critical for energy security, tech dominance. Industrial resilience stands out. No demand destruction despite prices doubling. Solar installations push records. Subsidies offset in Europe and Asia. EVs embed 25 to 50 grams each. Infrastructure more. Data centers explode. Power capacity up 50-fold since 2000. Silver in every server, switch, conductor. Thrifting attempts marginal. Conductivity irreplaceable at scale. This interlocks with monetary erosion. 346 trillion debt demands inflation or reset. History favors the former, revaluing scarcities. Silver, unprintable, dual purpose, fits perfectly. Insurance plus necessity. Compare Weimar's Ruhr, triggered to today's proxy conflicts, trade walls. Rome's wars to modern deficits. Patterns indifferent to, this time different. If you've tracked similar margin adjustments in gold or other metals this year, how do they compare in effectiveness, or lack thereof? Your observations and comments could highlight parallels I'm missing. The process accelerates non-linearly. Symptoms surge, premiums, delays, vault drawdowns. While regulators stay silent, media focuses equities highs, but COMEX eligible stocks thin. LBMA reports tight conditions persisting into 2026. Institutional pivot evident. Pension funds up allocations. ETFs absorb despite highs. Physical mints ration. U.S. mint sales records. Perth limits. Retail blackouts on large lots. Geopolitical layer thickens. De-dollarization, not rhetoric. Reserves shift tangible. Central banks hold more gold than treasuries collectively, first time since '96. If this reserve diversification aligns with what you're seeing in trade finance or international flows, detail it in comments. Cross-verification matters. System loses grip where paper detaches physical. Futures overlay held prices decades, but deficits intervene. 2025's squeeze. Refinery backlogs, lease spikes, shipment frenzies marks the turn. Mines constrained. Environmental rules, cost cap expansion. Peru output dips. Mexico stable. New projects delayed. Demand inexorable. Green mandates. Tech boom. Defense needs. Banks miscalculated. Margin tools flush some longs, but whales shifted OTC physical. Vaults offshore. Result. Spot commands premium. Paper lags reality. Historical resets followed such detachments. New currencies, hard anchors. We're mid-fracture, control slipping anomaly by anomaly. If wage stagnation against essentials feels tied to this broader erosion in your experience, explain the connection in comments. It contextualizes the human impact. Cycle grinds forward. Debt leverage demands resolution. Inflation, default stealth. Tangibles reprice accordingly. At $67 amid deficits, premiums, central hoarding. Silver discounted denial no longer. Silence from authorities, preservation instinct. But markets signal truth. Compression incoming, scarcity persisting. This isn't apocalypse. It's mechanics. Machine runs indifferent exceptions. Rome eternal, Weimar advanced, America exceptional. Math prevailed. If parallels to past cycles resonate differently for you, perhaps closer to one era, lay out why in comments.
Collective calibration refines where we sit. Phase locked, suppression misfired, physical asserts, cycle advances, inevitable.